All right, let's dive straight into IAS 102 share-based payment. Now, we're not going to be covering the 101 level stuff today. Instead, our focus is squarely on the high judgment areas, the things that challenge even the most seasoned professionals. We're talking about those complex vesting conditions, the nuances of modification accounting, and the very real difficulties in fair valuing instruments, especially when you're dealing with unlisted entities. So this discussion is really for those of you who are already well acquainted with the standard and are looking to master its most demanding applications.
So here's our roadmap for this analysis. It's structured to connect theory directly to practice. We'll kick things off with the foundational objective and scope, then get into the core mechanics of recognition and measurement. From there, we'll tackle the practical complexities of modifications and settlements. Then we'll hit the really crucial part of our discussion, the key judgments that auditors always challenge, before we wrap up with the extensive disclosure requirements that are so vital for transparency.
Okay, first up, objective and scope. Now, I know this might seem foundational, maybe even a bit basic, but getting this initial classification wrong is a common and, frankly, a critical error. For instance, misinterpreting the boundary between IND IS 102 and the financial instrument standards, that can invalidate all of your subsequent accounting. So let's define these boundaries with some real precision.
So, you look at paragraph 1 and the objective seems almost deceptively simple, right? But its application is, well, it's anything but. The core economic principle here is that an entity's own equity is a form of currency. When you spend that equity to acquire goods or services, that economic cost absolutely has to be recognized. This principle is a direct counter to the old practice of treating many employee stock options as if they were zero-cost instruments, which, as we all know, fundamentally misstated employee compensation expense.
And this, right here, is the first critical gate in applying the standard. As paragraph 6 makes very clear, the main scope exclusion has to do with financial instruments. The question you always have to ask is, are we acquiring goods and services? Or are we acquiring another financial asset or settling a financial liability? For example, issuing shares to settle a debt instrument, that's governed by IND IS 109. But issuing shares to an employee for their services, that falls squarely under IND IS 102. Making that distinction correctly is absolutely paramount.
So, with the scope firmly established, we can now move into the real heart of the standard, the recognition and measurement engine. This is where we get into the weeds of differentiating between equity-settled and cash-settled awards. And these are two paths with vastly different implications for a company's P&L and its balance sheet.
You see, the standard really forces a strategic choice between these two models. On one hand, you have equity-settled awards, which offer some P&L stability because the expense is fixed based on the grant date fair value. The trade-off, of course, is shareholder dilution. On the other hand, cash-settled awards avoid that dilution, but, and this is a big but, they introduce significant P&L volatility because the liability has to be remeasured to fair value every single reporting period. This is a critical trade-off that management and the board have to think through very carefully when they're designing compensation plans.
Now, this four-step process for equity-settled awards looks pretty linear, pretty straightforward, but step 2, determining that grant date fair value, that's where the real complexity is hiding. Sure, paragraph 17 refers to valuation techniques like a Black-Scholes model, but the key audit risk is in the inputs. I mean, think about it. For an unlisted company, how do you derive a supportable expected volatility? How do you justify the expected life of an option, especially with variable employee exercise patterns? These aren't just simple calculations. They are significant estimations that demand robust, defensible support.
And this distinction, which is detailed out in paragraphs 19 through 21, is such a frequent point of contention. A simple service period, that's non-market. A share price target, that's a market condition. But what about a condition tied to achieving a total shareholder return relative to a peer group index? Now you've got elements of both, right? The share price is market, but the performance comparison has a non-market feel. Classifying these hybrid conditions correctly is absolutely critical because it completely dictates whether the probability of vesting is baked into the grant date fair value or if it's handled via the true-up mechanism for non-market conditions.
Now, for cash-settled awards, like stock appreciation rights, the accounting shifts from equity to liability. And as paragraph 30 mandates, this liability is marked to market through the P&L each period. So what does this mean for a CFO? It means the company's own share price performance directly creates earnings volatility. A rising share price, which is obviously great for investors, actually leads to higher compensation expense. This creates a really counterintuitive P&L impact that you have to manage and explain very carefully to analysts and stakeholders.
It's pretty rare that long-term incentive plans just run their course without any changes. People leave, performance targets get revised, or maybe plans are canceled because of market conditions. So now let's turn to the highly prescriptive rules for modifications, cancellations, and settlements. This is an area where missteps can lead to immediate and very unexpected P&L charges.
Before we jump into the mechanics, it's so important to understand the governing principle from paragraph 27. And that principle is this: you cannot reverse an expense for services you've already received. The original grant date fair value acts as a floor for the total expense. A later modification might add to that compensation, but it can never retroactively decrease the value of the service that's been rendered. The only exception, of course, is if a non-market condition isn't met, like an employee leaving, which would trigger a forfeiture.
Okay, so the most common modification we see is a repricing, especially when a company's stock price has fallen. When you lower an exercise price, you have to calculate this incremental fair value. That's the difference between the fair value of the modified award and the original award, both measured right at the modification date. This extra value then has to be expensed over the remaining vesting period. And for cancellations, any unrecognized expense gets accelerated immediately into profit or loss. These are, you could say, punitive rules designed to make sure the full economic cost of any change gets recognized.
We're now going to shift gears a bit from the how-to to the what to watch out for. The application of INDAS 102 is an area of really intense auditor scrutiny. And why is that? It's because it is absolutely loaded with management judgments that can materially alter your reported expenses and equity balances.
This really begs the question, doesn't it? Where should auditors and audit committees be focusing their scrutiny? What are the specific, high-risk judgments that can materially swing the reported numbers and are the most likely to be challenged?
The high-risk list is very, very specific. For unlisted entities, just arriving and supporting inputs like expected volatility is a major challenge. Estimating employee forfeiture rates for the true-up of non-market conditions, that requires robust historical data and some solid forecasting. And as we just talked about, that initial classification of complex hybrid performance conditions is a massive judgment call. Every single one of these represents a potential point of failure in the audit trail and requires extensive, well-documented support from management.
And look, these aren't just theoretical risks. This is a direct finding from an ICAI compliance study. An entity measured its cash-settled SARs using the intrinsic value method. The standard is completely unequivocal here. As per paragraph 30, these plans must be measured at fair value with remeasurement through the P&L. Using intrinsic value is just a clear and material noncompliance. This is exactly the kind of fundamental error that immediately signals a control weakness to an auditor.
Finally, let's talk about disclosures. Given all the significant judgments and estimations we've just discussed, transparency is absolutely paramount. The standard mandates extensive disclosures so that users can deconstruct the share-based payment expense and really understand the potential impact of these arrangements on future cash flows and on shareholder dilution.
So, as per paragraph 44, the disclosures start with a qualitative narrative. And this is not boilerplate stuff. It has to provide a clear, entity-specific description of each plan, whether it's ESOPs, SARs, performance share units, and their key terms like vesting conditions, maximum term, and how they'll be settled. The whole objective here is to give an investor the context they need to properly interpret the quantitative data that's going to follow.
And this is where the underlying assumptions are really laid bare. Paragraph 47A requires entities to disclose the specific inputs they used in their valuation models. This level of transparency is crucial. It allows sophisticated users to do their own sensitivity analyses. By seeing the inputs, a good analyst can model how a change in assumed volatility or option life would have impacted the reported expense, and that gives them a much, much deeper understanding of the charge.
And you can see how the disclosures logically follow the accounting. If a plan is modified, paragraph 47C requires specific, incremental disclosure. You have to explain the nature of the modification, you have to quantify the incremental fair value that was granted, and you have to describe how that value is measured. This directly links the accounting treatment for modifications to the transparency required in the financial statements, which really closes the loop for the reader.
So this brings us to a really fundamental question, one that's at the very heart of INDAS 102. The standard is anchored in the principle of fair value. But when you consider the significant judgments, the reliance on complex models with subjective inputs, and the P&L volatility it creates for cash-settled awards, well, you're left with this persistent debate. Does this model always provide the most decision-useful information? Or does it, at times, introduce more noise than actual value? It's a question that continues to challenge standard setters and practitioners alike.